Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you the difference between an income calendar spread and then a calendar diagonal spread. So what I'm going to show you is an income calendar spread first, starting out with IBB. So this is the biotech ETF. Okay, so anyway, this you can see where it's trading right here, about 104 in that range. And when you're doing an income calendar spread, you're doing kind of a strategy, kind of delta neutral for a range bound. So potentially, maybe it could hold a range of between 100 up to 105 or 107. Something like that. We use standard deviations, but that's the basic concept of the strategy. Now, when we use a calendar diagonal, it's got the income component, but what it does, it adds a vertical component to it as well. So we're playing actually a potential for a directional trade. So I'm going to show you one for setup for maybe the directional trade up versus the income calendar for just kind of a range bound, and show you what the key differences are to this spread. So here's the construction of an income calendar. So what we're looking to do here is go out to like the 20 September series. So this 20 September series, this is about 99 days out till expiration. So to buy that around the 105, we can push it up, close up above 104 or below, just somewhere close to that. Looking for kind of a little bit more of a directional move up. So going to select the 105 strike. So that's going for about $4.80 or $480. Now the key here is you can see that it's got a negative theta. So it's going to lose, starting right now, 99 days out, it's going to lose $2.75 per day. So very low theta decay. Now, when we look at selling the July 19 series 105, that's going to make a income calendar. You're going to see the difference, and you get $240 credit for that. So if you look at the theta decay on that, it's $4.42. So that's a theta delta of $1.69. So you're gaining on this income strategy $1.69 per day. So that's how you're going to make your money. So if this stays range bound in a range like between here 101 to 109, and it goes out in this range in here, you're going to make money off that theta decay. Now about the max money you can make on here is if it went out right at 105, you make about $140, $145, kind of like a butterfly. So you're taking advantage of that theta decay and implied volatility going to zero. Now here's the big difference. So you can see the difference, see that the way that the structure looks, it looks kind of like a butterfly, so we're just playing volatility and theta decay. Now, if we want to add another kind of the directional component, what I can do is I can, instead of selling the 105, I can sell the 110, July 19 series 110. So I've got a $5 spread, all right? So I'm going to still have theta, the benefit of theta. If I just bought the outright 105 call, I've got a negative theta of 275. But when I sell the 110, I've got a positive theta of 241. So I've almost got a positive theta. Just it's kind of a flat on theta decay. So I'm not losing anything. But what this can do for me is if this thing goes directionally and does go to the upside towards my target of 110 here into expiration, this can potentially make over $290. So it's got a potential to make 85% or more. And that's if you just left it on as a calendar diagonal without doing any adjustments. So I wanted to point that out. And so these are really great trades for kind of a delta neutral where you think the market's going to kind of turn sideways, but if you want to add that vertical component to it for directional trades, you can really get some fantastic payoffs and profits. Hope this helps. I'll talk to you on my next video update.